Folks, hello, welcome to the show where we will be showing you how you can moneyball your private equity deal sourcing, or if I were to put that in a different way, what we want to show you is how you can really just work less hard for better deals by taking a data analytics approach to your pipeline. And we want to tackle this subject because we're seeing a lot of private equity firms who are able to review more deals annually at the firm, but too few GPs are using data points hidden inside of their own pipeline, as well as metrics like the sell-side process index, which we'll get into in a bit, to make all of that work easier. So it's not just the deal flow quantity improving, but we want to show you how to also improve that deal flow quality without stressing yourself out. More on all of that in a bit. First, allow me to quickly introduce myself and breeze through some quick housekeeping. I'm Nick Donato. I'm an industry specialist here at Navatar, which is a cloud software provider for the private funds marketplace. I will be your moderator, and I'm going to do my best to keep things short. We'll reserve some time at the end for your questions. To submit them, just use that go-to webinar widget that should be on your screen there. And also, because this comes up a lot, yes, a recording of today's broadcast will be made available to everyone. Just look for that in your inbox in the coming days. And before I introduce you to our main presenter, allow me to give you the quick background on Navatar. We are considered the premier cloud software provider in the private equity and wider private capital market space. We have over 600 customers across 35 countries. And essentially what we do is we offer you a platform that makes it easier to manage your investors, your deals, and your portfolio. So in the context of deal sourcing, the theme of today's webinar, what we do is we offer you a way to boost deal flow and pinpoint which intermediaries are providing you the best deals. So that way you're always earning, you're keeping your own firm visible to that seller, so that you're always earning first pass the most promising investment opportunities. In fact, if you go to navatargroup.com, you can see what some of those tools look like and hear from our clients, one of whom provided testimony that Navatar had led to a 400% increase in deals reviewed annually at his firm. But that being said, I'm now excited to be introducing you to our main speaker, Nadim Malik. Nadim is considered a data guru in the industry and is the founder of Sutton Strategies, which is a data analytics provider for deal makers. So Nadim, can you give us more background on you and your firm?
Yes, thank you, Nick, for having me. Really excited to be here. Just to build upon what you said, we are indeed a data and technology company that focuses specifically on working with private equity firms, lenders, and M&A advisors and service providers to optimize their business development and deal flow. We've been around since 2009, have worked with over 100 firms, and actually before starting the company, I was a business development professional for a private equity firm for 6 years, but with a very data orientation, not the relationship person. My background before then is with Thomson Reuters to help them build some financial information products and databases. And Nick, it was really the synthesis of those two experiences, financial data and information, and what was most critical for deal sourcing that led to the genesis of Sutton Strategies in 2009, where we saw a real opportunity to apply data and analytics to deal sourcing to improve, and given how critical it is then and even more critical now. And it's kind of all we focus on. We're very niche. We feel like we have our pulse on that market, deal sourcing, private equity, and I look forward to sharing some of the stats and takeaways that we've learned over the years on the panel.
Thanks, Nadim. And so you and I are sharing a coffee together, and we were talking about this presentation and how we wanted to frame it. And one of the interesting things that you had mentioned was just how much deal sourcing has evolved, really maybe in the past 5 years or so. And you had this concept of a deal maker either being proactive or reactive. And I think to set the stage here, if you could provide the audience some insight into that.
Yeah, Nick, I think to understand where we are today, it's good to take a look at the evolution of private equity and where it started. So back when private equity was just starting out and gaining traction and picking up, the dynamic between investment bankers and private equity firms was such that private equity was a whole new asset class and group of buyers that they could bring to their sellers and targets than when it was time to sell a company. So just picture a widget manufacturer, medium to small size company. Maybe there's only 5 or 10 other strategic buyers that might be a good fit for it. All of a sudden with private equity firms, there's all these other potential investors and buyers. So for good reason, investment bankers are very hungry and eager to, for their clients to spread the word and get as much penetration and reach out and identify the private equity firms. And at that point, if you were a private equity firm, you could afford to be reactive when it came to your deal sourcing, since you were being sought after. Fast forward to today, and the pendulum has really shifted. In the private equity market has grown so considerably. It now constitutes, between new platforms and add-ons, over 40% of all of M&A activity. And there were 1,500 private equity firms just last year alone that did a deal in the US or Canada. So for a private equity firm, if they want to be in that deal flow and see the opportunities that are relevant for them, they are the ones that need to get share of mind and if kind of chase the investment bank. So that pendulum has swung the other way, and you really have to be proactive today from a deal sourcing perspective if you're a private equity firm.
And I know that one thing, because that pendulum has shifted out of the buyer's favor, you were offering them a tool to measure their performance and how much deal flow they're seeing. So what I want to do now is bring up a chart. And then Nadim, if you could walk our audience through the significance of this chart and how it relates to what you had just said.
Yes, thanks for reminding me on that, Nick. Yeah, so I think this is a nice illustration of what I just described. So this chart juxtaposes two things. The yellow line is quarterly average deal flow that a private equity firm sees. And so it's about 125 or so per quarter, or 130 it looks like, more like. So that means the typical private equity firm is seeing about 500 deals a year, roughly, give or take. And you can see that line has been steadily increasing. Interestingly, it seems like it might have flattened out recently, but overall the trend is clearly upward. The bars, the columns, represent closed M&A and private equity activity in that same time frame. And as you can tell, that has been flat, if not going down. So all this proactive nature and the importance and significance of yielding more and more deal flow, it's being illustrated in this chart, because you can see deal flow is continuing to go up and up and up, but it's not like there's more inventory out there. It's not like there's more deals getting done. And I think this can create a little bit of frustration, because a private equity firm may feel like, hey, our overall volume is going up and up and up, but why aren't we getting deals done? And that has a lot to do with the valuation challenge and where the market is today.
And because this is happening and they are experiencing that frustration, is this what's leading more private equity firms to hire dedicated business development professionals? You had mentioned that this was part of your own work history. What would you say to a business development professional given the insights of this chart?
So, so how has private equity, Nick, addressed this need to be more proactive? I think the biggest thing we've seen over the years is the rise of the business development professional. This is someone that spends a majority, if not all, their time sourcing deals. And yes, back when I was part of a business development team for a private equity firm 10 or so years ago, there were probably only 30 companies that had a dedicated BD person or team. And today, it's approaching half the market. It's over 500 firms, according to our estimation, currently have a person or team. And the next wave is, if you have one person, they're starting to add more. And Nick, anecdotally, it makes a lot of sense. Traditionally, when in a private equity firm, when the partners or deal professionals are also charged with sourcing deals, what inevitably happens is, once they finally find that deal that's gotten to a later stage under exclusivity, they go into the quote-unquote deal bunker. And they could stay there for 6 weeks, 3 months, maybe even longer. Their life is all about closing that deal, and for good reason. And then maybe the deal closed, maybe it didn't. They come up for air and they look for that next deal. And during that three month period, or however long it was, they weren't proactively reaching out. Forget proactively reaching out. They might not even had the opportunity to respond to inbound deal flow in a good manner. So having, in that same scenario, having a dedicated BD person or team allows you to, even out that ebb and flow, and they can respond to those type of inbound flow, form relationships with new intermediaries as they're coming up, and not only plant seeds for today, but for many years around their deal flow and pipeline. So anecdotally, intuitively, it makes sense, and it's also starting to show up in the stats, in the market coverage. So according to our most recent deal benchmark analysis that came out in September, if we look at our 7 peer groups, and the peer groups are such as sector focused, upper middle market, etc. While only half or less of our clients have a dedicated BD person or team, which is a reflection of today's market, each best-in-class performer in each of our 7 peer groups actually had a dedicated BD person or team. So it's definitely translating into better coverage and better deal sourcing if you have a business development professional.
And just as an aside, how has that role evolved in terms of their position within the company culture? Or have they been elevated in status?
They have, Nick, over the years. Initially, and it's happened, I guess nothing happens overnight. It has taken 10 years or so or whatever, but I think it started out with some uncertainty. There were just a handful of firms where deal sourcing was just embedded in their culture and their senior partners. Maybe they had a marketing background and they identified it. And, other than those handful of firms, it was kind of marginalized. You didn't want to get away from deal execution. That was where the real, power of private equity lied, not in deal sourcing, but it's changed a lot. And I would say the biggest change has occurred to the point where a couple of years ago, a business development professional, I'm sure many people know, Ted Kramer of Hammond Kennedy Whitney, actually got elevated to CEO of the firm, rising the ranks from a business development professional over 11 or 12 years. So it's definitely evolved in importance and significance and in the role that they can play within the firm.
And I know that we're going to get into this more heavily in just a bit, but I think one of the important points I've heard you make is that technology has underpinned a lot of the forces behind this evolution. Could you expound upon that?
Yeah, Nick, we're at a point in in the world where technology, it's rare that technology hasn't impacted or changed or transformed, typically for the better, most industries. I would have to say private equity has been a little bit of a slow adopter here, but I will point out 3 technological trends that we've seen over the last decade. And the first is a CRM, which I'm well. Not too many firms today are keeping their pipeline in Excel or Access or trying to put something together in that format, and have migrated to a more sophisticated CRM platform, which is not only great. The metaphor I like to use is, a good CRM is like a good 6th man for a basketball team. It tells you where to go. It gives you reminders, allows you prioritize. It gives you great reporting and analytical ability for your LPs. So that's the first trend in terms of technology in business development. The second trend I wanted to mention was online marketplaces. So these are exchanges or marketplaces, firms like Axial and PE Nexus, which can bring buyers and sellers together in an efficient manner, use technology, and that could be an efficient way to see different opportunities as well. And then the third category of technology are firms such as Sutton Place Strategies, where we have built a purpose-built technology on top of some data purely to help private equity firms improve their deal flow, which we think will improve their fund performance, and a mobile app and all sorts of algorithms that can help them optimize and improve their deal sourcing.
Yeah, and this, I think, takes us to really what's the larger point in all this, and that going, you need to use this technology if you're going to take a data and analytics approach. That no longer is the BD professional, despite their rise in stature, wholly a relationship-driven profession, that you've got to have some numbers to back up your claims and your value add. If you could talk about that.
Yeah, I mean, technology is very closely related to data and analytics. And, you know, Nick, anything mission critical to a company, to a project, any endeavor, anything mission critical to that endeavor is going to get measured. There's going to be a lot of light shed on using data and analytics, and for good reason. And the metaphor I like to use is, actually, before I go into that metaphor, where I was going with that point is private equity deal sourcing has evolved in significance to the point where it is mission critical to the firm. And data and analytics is going to play a key part and a growing part. And a good metaphor to use is baseball, like the Moneyball concept in the title of our webinar. You know, today, think about the advantage one team has on another that is deploying cutting-edge data and statistics and analysis as part of their strategy versus a team that's not. And, you know, it's crazy to even think about that today, but, you know, it wasn't even common until about, you know, 10 or 15 years ago. And the same is, I think, going to come true of deal sourcing, and has come true, and it's even going to get more and more sophisticated in terms of using data and analytics to give yourself that edge against your competition.
Yeah, and I think that's right. And so, well, thank you for setting the stage here about the evolution of deal sourcing and what led to this concept of Moneyball, as you just mentioned. Let's get into the weeds then. So we are mentioning that you need to use data, you need to use analytics. How exactly is the time-strapped analyst going to use this data and these different metrics to make their work life easier?
Yeah, that's a really good question. So what I wanted to do to illustrate that, Nick, is to walk through some metrics that we put together for our clients on an annual basis. We call it the Deal Origination Benchmark Report. The acronym is DOBR. Try to get it to roll off your tongue. But so this is an opportunity once a year. This just came out in the September timeframe to all our clients that qualify to be included, that meet our data integrity threshold. And in the past year, this analysis, which I'm going to walk you through, consists of 129 different private equity firms that qualified. And so I just want to walk through a few of the ways that we can offer private equity firms a perspective on their deal sourcing and allow them to adjust their behavior accordingly. So on this chart, if you look at the left side, there's three categories. I want to start by looking at the market coverage and deals by all intermediaries. Where it says client stats, that column, that's just picture, you know, some client, its name, so you can see its different stats. And then we compare what their market coverage is. Let me just explain quickly what we mean by market coverage. That is the percentage of deals that a private equity firm saw that met its criteria, size, sector, that were ultimately closed by a private equity firm and had a sell-side advisor involved. And and if you shift over to the far right, I want to draw everyone's attention to all sponsor stats, which includes all 129 of those firms. The median market coverage in private equity today is under 17% in terms of the percentage of deals they saw that in an ideal world they would have liked to have seen. And if you look at the line below that, when the company was represented by a boutique advisor, that coverage drops to about 10%. So this is a common theme and takeaway in our messaging in this panel as well, that there's a lot of opportunity among those boutique advisors to capture share of mind, and it's still pretty inefficient out there. And then we have some additional line items. How well are you covering the most active intermediaries? How much have you improved in the last 6 months? How much have you improved in the last 12 months? And then moving on to the second bucket, and we're going to go into a little bit more detail of this later on, but this perspective in terms of sell-side process allows our clients to see how is their market coverage for different type of process types, if limited, moderate, or broad. And this is really interesting because it's important for clients to know, especially with their most key relationships. Yeah, when they run broad processes, it's great that you're on the list and you're seeing them, but what about those instances when they run a little bit more narrow processes, where they're not inviting so many people? Or what about the boutique advisors in general that maybe don't run as many broad processes? What is my share of mind there? And should I make some adjustments? And then finally, we have a category of macro metrics. I won't go into each one, just a couple that resonate with clients. The number of deals seen, the deal flow, the third line item in that category. As you can see, a private equity firm on average, the last time we ran this, is seeing about 448 deals per year. And we have certain clients, of course, that have 10-person BD teams and are seeing thousands of deals, and we have other clients that only need to see a little bit over 100 deals to meet their investment mandate. So it can be a pretty big range, but it's always good to compare, especially against your peer group, how you compare in that area. And then and then another one above that, number of BD professionals. It's very common for our clients to say, hey, how many do we have? How does that compare to the industry median, and so on and so forth. So, so Nick, these are some statistics that we track. This is only a small snapshot of what we provide. We also break down market coverage by geography. You know, are there certain parts of the country where there's deals getting done that, you know, you're not being thought of, that are very relevant for you? Are there certain sectors within your focus that you have more presence in that you don't? So these are the types of analytics that you can process, interpret, and make the necessary adjustments at more of a macro level from time to time. And then, of course, the next step and the key is to then deploy the tactics and the raw data and the technology at your disposal to apply all of those to improve your sourcing overall.
And Nadim, with respect to the market coverage, if I'm your average middle market private equity firm, what do I want that number to be? When am I starting to feel confident that I'm seeing enough of my target market for deal flow? Because surely it wouldn't be 100%, but how low would you? What's the strike zone?
Nick, that is a really good question, and you know, this might be sound odd coming from a data geek such as me and such as SPS, but the reality is that sometimes you have to understand what's behind the data, what's behind the numbers. Sometimes people think data equals science equals complete perfection or accuracy or whatever. The reality is data at best is designed to tell you a message, a story that you can then act upon. So what is the perfect coverage? It really depends on the client. What is their focus? What is their sector? It could maybe a 15% coverage meets their needs if they only want to do a deal a year, or they only have a very broad mandate, opportunistic mandate. Maybe if they're very sector focused, it could be much higher than that. So it really depends. And what we say is it's not the absolute coverage that is most critical. It's that the trend over time should be continuing to go up. So on a relative basis to yourself, you're getting better and better and continually improving.
So just below that, we of course see the sell side process index. I want to get more into that because really, let's break it down. Let's get into how to use some of this data. And if we could talk about the SPS index there, you've provided to me this concept of the missing middle, and which intermediaries, if you have limited hours in a day, you're a time-strapped analyst or BD professional, which sellers should I be focusing my time and attention on? And I know that you have some data to help people pinpoint who that should be.
Sure. And yes, I wanted to leave, Nick, like we discussed, 4 tangible tactics that people can use, if they're not using already, immediately to start improving their deal sourcing. So the first of those is understand which intermediaries run more limited processes. And to help illustrate this point, Nick, if you don't mind bringing up that intermediary league table, just to show people a breakdown of the intermediary market as a starting point. So this is a perspective of the 750 plus intermediaries that did a deal just in the last year of loan of at least 10 million or greater in enterprise value. And what we have discovered through the sell-side process index, which by the way is a algorithm that we created that allows private equity firms to determine on a relative basis compared to their peers what type of process an intermediary typically uses, limited, moderate, or broad. And what this sell-side process index revealed to us, which we launched about 1.5 years ago, is that once you get past the well-established firms on the left of this chart that are running more broad processes as expected, and the sell-side process confirmed that, the vast majority of the remaining firms are actually running more moderate or limited processes. And that makes them very, very challenging and very, very attractive to cover. Because, you know, challenging by virtue of the fact that they run limited processes. They're not going to show it to a lot of buyers. And so how do you get in front of them? And attractive because the biggest theme we hear today, and the biggest, you know, concern for private equity firms is, you know, where we are in the cycle and where valuation is. And it seems to be at the high end of their historical range. And people have been saying that for a couple of years now. And so that really puts pressure on private equity firms, if that's what they feel, to deploy capital in an efficient manner, you know, that will meet the hurdle rates of their investors. So, and you know, it's not like a limited processes will completely remove the valuation challenge that exists, but I tell you, most private equity firms will agree it will certainly help if you only have 3 or 4 other firms looking at a deal in terms of competition. So takeaway number 1, understand which firms run the most limited processes and treat them a little bit differently, because those are attractive opportunities.
That's right. And just bringing it to the second point too, it's a timing issue. So reaching out to new deal sources in a timely manner. If you can elaborate on that.
You know, it sounds really simple, Nick, but I can't tell you how many firms aren't really doing this in the proper systematic way. Let me just put some numbers behind it. In the last year alone, there are about 140 new sell-side intermediaries that sold a business for the first time in the US or Canada. Now, maybe in that same year, a similar number or less went out of business. My point is there's a lot of change and churn in that area. New firms are coming up. And that's 35 a quarter. You know, if you break it down, that's 1 every other business day. So it's not like we're talking about a huge volume of data or, you know, huge information, but you should have a process in place to identify those, reach out to them, add them to your contacts, form that relationship before everyone else does. You don't want to wait years and you know, after they've already spoken to 50 or 100 different private equity firms or business development professionals, you want to reach out to them quickly. So, it seems like a simple takeaway, but when you look at the numbers, it can really add up and create that opportunity and constantly find new prospects and new deal flow. Many of these firms, of course, the challenge and the criticism of the new firms, there's no guarantee that they'll do another deal, right? They might be one and done. They might not, or a deal in my market just because they did another one. And surely that's true. But the flip side of that is many of these firms will do many more deals for your market, and there's no way of telling which ones are which. So if it was thousands and thousands of companies that you had to mine, I could see the frustration. But given it's a manageable number, if you're systematic about it, it's very important to reach out to these in a timely manner and have a system in place.
Right, and speaking of new deal flow, I know this goes into our third best practice. It's that for the deals that end up becoming broken, that you treat that as an additional data point, that is something to utilize because you should be regularly reaching out to these people. If you could elaborate on that. Yeah.
The third tactic I want to talk about, and you know, I'm sure this is going to sound familiar to a lot of the people on the call today. The concept of the broken deal, and the story is, you know, Nadim, we saw this deal 3 or 4 years ago, and we weren't the winning bidder, but we really, really liked it, and we made a good impression, and we hung around the hoop, and it didn't end up closing, and they came back to us, and we got it done. It was one of the best deals we've ever done. And I've heard that story many times, and then it also followed, you know, and then I asked, well, do you have a way to systematically do that and follow up and try and recreate that? And most firms don't today. So the concept of you know, a private equity firm's own pipeline is a treasure for potential deal opportunities. And so what I really mean by that is go through that pipeline, have a system in place. I mean, certainly with SPS, there's a section in our portal where you can look at your pipeline and be alerted for new opportunities, for opportunities that you liked that didn't end up trading that met your criteria. But you don't need the SPS portal to do that. You can do your own research and digging and figure that out as well. And it's really, really critical. And the reason that this is so attractive, Nick, 3 reasons. Number one, you've always, as a private equity firm, you've already done the work and the diligence, and you know that you like the company. Number 2, you have probably met the management team, surely, and have a good impression there as to. And number 3, you also know that price wasn't the deciding factor to get this deal done. And those are 3 really compelling reasons to have a system in place to mine your pipeline for broken deals.
And then, Nadim, the fourth concept that you brought up, which I found really interesting, was just also having this data point of knowing the seller's closing rate.
Yes.
Could you speak about that?
Yeah, sure. So this is probably going to come as a surprise to a lot of people, but according to our work with our clients, only about 35 to 40% of deals that are seen by private equity firms, or more correctly, that are actually logged, that make it to the log, end up trading, period, end up closing to anyone. So 60 to 65% of deals don't actually get done at all. And so it's very important to know what the closing rate, what the quality of the deals and the engagement of the seller is for different intermediaries. And that range is going to vary from firm to firm. The more established firms, their closing rate could be 70 or 80%. And for boutique brokers, they might be, they might try bringing 3 or 4 deals in a year to the market, and none of them close. So it could be as low as 0%. So it's very important to have this metric in place. Know your relationships, your intermediaries, and the deals they've shown you. What are their closing rates? And compare within the bands. Obviously, you can't compare a boutique firm to a well-established, like a Houlihan Lokey or a Harris Williams, that are going to have higher closing rates. But within each band of boutique and mid-sized firms and more established firms, what does the closing rate of the deals that they bring you, how does that compare to other firms in that band? And surely the ones with a higher rate, that's going to tell you a little bit something about the quality of the deals and the engagement of the sellers that they typically have.
Thanks, Nadim. And I want to say to the audience too, like whenever the conversation is around data and analytics, these at times can be difficult to conceptualize or see clearly. So what I would like to do now is bring in our COO, Kate Kantar, who is going to help us give some light, give a visual on some of the points that Nadim and I are making. So, Kate, I'm going to pass this over to you, and if you could ground some of the points that we're making, that'd be great.
Great, thanks, Nick. And before we go into kind of on the technology side of things, I did want to echo, I think, at the very beginning, a point that Nadim made, which is something we keep hearing too. A lot of our customers, a lot of our prospects who are reaching out, talking to us, they are becoming more and more curious, more and more focused on deal sourcing. So it is a question that we hear often. It is obviously based on that, something that all the private equity firms feel is an important enough area to focus on, and many times we're also seeing a lot of dedicated effort in those areas. For today, I wanted to just spend a couple of minutes to bring to life some of the points and how the CRM system is not just a technology to manage relationships, but it can also help and manage your processes and your outreach. And we'll focus on the deal sourcing. So just to give you a sense, a lot of our customers, what they're doing is using Navatar to segment their bankers, right? So they will create different tiers. And again, it's an iterative process. You can go through, change tiers based on your relationship. But what a system like Navatar can do is remind you to execute on your strategy. So tier 1 bankers, I want to make sure we're reaching out every 3 months. Tier 2 bankers, I want to make sure we reach out every 6 months. And the system will proactively tell you who these bankers are. It's time to reach out to them for tier 1 and tier 2 based on the communication strategy that you've set up. And that's important because in the end, you do need to set up this relationship and manage that. And then along with that, as you manage the communication with them, equally important is to also set up your own metrics. And again, the metrics that we were tracking dove very nicely to the points that Nadim had made, where no longer is it just the quantity of deals. So if you look at this graphic, I can see Paul and George and how many deals they have sourced to us. But increasingly more important is also the quality of the deals. So a system like Navatar can also help you set up and assign data quality to all these deal sources that you're working with. So this kind of sets up a process that you can follow and utilize, where you can then, for all the intermediaries that you're reaching out to, you can set up tiers, you can set up a communication strategy, reach out to all of them. And as you're kind of sourcing deals and as you're working with them on deals, my final example here, I'll show kind of that you can also, for every intermediary, you can now get some metrics. You can assign kind of different metrics based on the intermediary, based on the deals that they're sourcing, and also assign quality numbers directly to them. And so this is in addition to what you would always think of a CRM system to do, which is helping manage all your communication, helping manage kind of information, but this also allows you to track and manage your deal sources, as well as the details of every single deal that we've been tracking. So I thought those would be points that could kind of also enhance this discussion and bring to light some of the things that Nadim was talking about. With that, I think we can go into questions if there are any.
Yeah, Ken, and a few have come in. One is how you are defining the quality of the deal.
That's a good question. I think at a macro level, you do want to define the quality based on how far the deal went through your process. And each of you probably have your own steps and milestones that you track. So a deal that got rejected in step 1 is obviously a bad quality deal versus a deal that went, let's say, reached step 4 out of a 6-step process that you have. So you do want to measure it based on how far it went down, and then based on each step, you can also assign weightages to then come up with a quality rating.
And Nadim, this is one I'm going to throw in your direction. You had mentioned at the beginning of our show that the rise of the business development professional. Someone is curious to hear your thoughts on where you think that profession is going in the time ahead.
Yeah, no, thanks I think that's a really good question. Nick, so I remember, as I mentioned earlier, when the announcement went out, or I found out that Ted Kramer had been promoted to the CEO of the company at a private equity firm at Hammond Kennedy Whitney. And, as a BD professional, as someone that's worked with many, I've had a lot of friends in the industry, have seen it grow, have seen some of the challenges, and it felt like it was a really, really big win for the team and for everyone. And I do think it just makes a lot of sense, for someone with the soft skills, with the knowledge, both on the deal side, with the deal sourcing, which has become so critical for LP messaging, that person, provided that the firm's culture is right, and obviously it's not going to be a fit everywhere, but I don't think that's going to be the last time we're going to hear that. So where do I think the evolution? I think it's only going to become more important. I think the next wave is, if you have one person, you're going to need additional people. And I do think, and I'm not going to name any names now, but you can certainly, if you know the industry, you know the business development professionals and firms, you can certainly pinpoint people like, oh man, that he or she would make a perfect CEO of that firm. So I think 10 years from now, there's going to be more examples of TED within the industry.
I'd like to get in at least one more question, and this is open to either of you. Someone is asking about this concept of ranking your intermediary relationships, how exactly that scoring works.
So for us, Nick, I'll address it first. So I think, there's two components from our perspective, and what we hear from our clients and how we treat this matter with our clients. The first is as quantitative as you can get. Are they showing how many deals are they showing in your target criteria a year? What is their closing rate? Are they and anything else, how far are they going down the pipeline, so on and so forth. The ranking of the intermediaries, as much as you can get quantitatively, that's one element. But I think there's a second element. There's the qualitative element, and that is, you can't really put it in numbers. The rapport, it exists of the rapport that you have with the intermediary, and the level of trust that you have, the years of experience that you have. Maybe they don't show you a lot of deals because they know exactly what you want to see, and they're not going to waste your time with stuff. So it's both quantitative with the right mix of metrics given your strategy, and then there's a qualitative element that's subjective to each firm.
Kane, did you want to add to that at all?
No, I would concur with that, and that's something that we also see our clients utilizing. I think from our vantage point, it's all based on the data that they're tracking within Navatar and kind of how to utilize that to give similar analysis, both in terms of number of deals, but also in terms of quality of deals.
Well, thanks to both of you, and that just about wraps it up for us. If we weren't able to get to your question, you could see the contact details for both myself and Nadim. Either of us would be happy to respond to your inquiries. Also, if you like today's webinar, I encourage you to check out navatargroup.com. We have a number of webinars that are focused on deal sourcing best practices, so give those a look. And on behalf of Nadim, I'm Nick Donato, and we hope that you enjoy the rest of your day.
Thanks, Nick. Really appreciate it.